Hey everyone, welcome to the show. Today we have a very special guest, and his name is Ryan Telford. Ryan is a private investor based out of Canada. Ryan, welcome to the show.
Thanks, Robin. Thanks a lot for having me.
So I heard just recently, I think it was a few days ago or a couple of days ago, that you were gained entrance into the Microcap club. So congratulations.
Thanks a lot. Yeah, no, thank you. It's
And what was the company covers the company research report that gained you entrance? What was it?
it was Mass Tech Digital,
Okay.
ticker is MHH. It's interesting microcap. It's been a high performer, and it's had a nice little inflection, which is kind of the basis of the thesis. So for anyone who's a member, head on over there, check it out. As we'll get into, I take a quant approach to investing, so there's a lot of charts and data like that, which drives a lot of my investing.
Okay, can't wait. So tell us, how did you get started in the microcap world? What was your journey leading up?
Sure. Well, I mean, I guess kind of. I mean, I've always been an investor. I mean, most of my working life, and maybe I could take a step back. So I'm actually an engineer by background. That's my education. Currently working as a project manager for a mining consulting firm. I'm doing that for quite a few years. And I've always been investing, but the last 10 years or so, I've taken more of an active approach, kind of doing it my own way, learning, making lots of mistakes. And then about 7 years ago or so, I discovered quantitative investing, which is basically just using a lot of historical data to help drive investing strategies to help make investing decisions. It's very non-discretionary, so it's very data driven. Another term for it is evidence based. So you can look at data, and instead of sort of making your own conclusions from maybe your own experiences and such, it's actually you can look at very specific historical um, situations and see, okay, which factors actually drive stocks to perform. So that's kind of what I've been doing in the last 7 years or so. And then in so doing, I discovered that really a lot of opportunity is in microcaps. They're great stocks, great opportunities, potential for higher returns, and they seem to do well with quantitative strategies. I mean, microcaps are relatively simple businesses, so their financial statements are relatively straightforward. So you're able to extract a lot of good stuff and understand those businesses to help build your strategies and work on your long term performance.
And do you limit yourself to Canada, or are you all over North America hunting for small microcaps?
Canada and the U.S.
Yeah.
mostly. Um, and microcaps is a very vast universe.
Hmm.
In fact, of the 10,000 stocks listed in the U.S., over half of them are microcaps, which is crazy. I mean,
Hmm.
it's a microcap is only $300 million or less in market cap, but yet they're everywhere.
Yeah,
So
which means it's the majority of the Canadian market then, right? There's so many small companies.
absolutely, in
Yeah.
Canada it's even higher. It's
Yeah.
it's just shy of 80% are microcaps
Wow. So
in
there's
Canada.
a lot of fish in the sea, right? And which in one way makes it more challenging to sift through everything, right? All the not so good
Absolutely.
candidates. Yeah.
Yeah. I mean, let's be honest. There's a lot of opportunity, but there is risk too. So
Hmm.
you just got to be able to find those signals and those red flags and just steer clear.
Absolutely. So which is great. You applied your engineering framework and discipline to what you call, I think, the 10 factors that determine 10x stocks, right? Stocks that can go up 10 times. And I believe you've prepared material for the podcast too, right, Ryan? That we
Yes,
can go through in
indeed.
detail. That's
Yeah,
awesome.
let's
Yeah.
do it. Let's do it.
Okay.
So 10x stocks. So what are they? 10x stocks are basically a variation of a multi-bagger. So a bagger is it's just a funny term that basically Peter Lynch came up with in his book Went Up on Wall Street. I think a lot of investors, a lot of viewers have probably read it. It's basically just a two bagger is a stock that's gone up 100 times or 100%, a 2x. You have a three bagger, a 3x, 5x, 10x, 20x, 100x, 1000x. In Lynch's book, I mean, he showcases some that were just ridiculous, like 1000x and higher. And it's just, it's kind of the, it's kind of the very elusive stocks that everyone's trying to find. And I mean, if you can really catch those and hold on, I mean, those are life-changing stocks, really. Another really popular book is Chris Mayer's 100 Baggers, which he goes through some criteria on stocks that have gone up 100 times, and really what those sort of stocks are. Now, as you can imagine, the higher the returns, I mean, the more rare that these stocks become. I mean, they really are difficult to find. They usually have a long history. Like it takes years to get to 100 bagger status, even 10 bagger at times. And as we'll see, that path is not usually a straight line. It can be very volatile, and it can be hard to. Only in hindsight can you really see how the stock became a multi-bagger. So as you mentioned, Robin, so on Twitter, over the last year or so, I've done some research on 10x stocks, and I've shared a lot of my findings on Twitter, just through different posts, through different threads, and so we'll get to some factors that I found that a lot of 10 baggers actually share. But before that, there's just a few items would be interesting to go through. So a 10 bagger. So what is that? That's 1,000%. Now, or technically it's 900% really. But what is that? So if you take the S&P 500 from 1994 to 2024, it's basically 1,000%. I mean, that's 30 years. I mean, even from this line, I mean, you can see you basically lived through the dot-com bust. You went through the financial crisis, had a nice run in the 2010s. And of course, COVID came, which was fantastic after. And then you had the Fed tightening, and then you had the latest run up. So really, to achieve that 10x, you really had to hold through quite a few cycles or downturns.
It's an important lesson, right, Ryan? I think that people in the past 10 years have looked at the S&P and said, hey, it's just a total no-brainer, right? It'll just keep on going up. But there was a lost decade in the U.S. at one point between 2000 and 2000, all the way until 13, where, and you can see it in the chart itself, right, where you have this long period of consolidation, and there was those two major drawdowns, as you said, the tech crash and then the financial crisis. And really, so it's not it's not an overnight success. There's a lot of waiting. You have to be patient. And I'm sure that's one of your conclusions for 10x stocks, and especially the 100 times. Sure. If you're investing in 100 times, sometimes they're pre-profit entries to even achieve a return that high. So please go ahead with the findings.
Exactly. No, great points there, Rob.
Yeah.
Okay, so we know what 10 baggers are and multi-baggers are, but how many are there? That's always a question that I get from people. So if you just take the last 10 years and the universe I checked, basically I removed like the really small stocks, like some OTC and some of the biotechs. Those are kind of wild cards, so I took those out as well. But basically in the last 10 years, just over 1,000 have doubled. They become 2xers. And then of those, we'll call it 1,000 for round numbers. About 24% continued to 5x, and then 6% of that same group went on to 10x, and then it just falls off a cliff here, and to get to 100x, we're talking like 0.1% of those stocks that doubled actually made it to 100 bagger status. which is NVIDIA. So yeah, it's obviously, I mean, that pond gets smaller and smaller and smaller as you go. So just something to be aware of. I mean, these are very elusive stocks. The higher you go, and as we'll see later, I mean, while we're talking in this area, 10 and 20, there's a lot of opportunity here, and I think a lot of people miss that. Everyone's got their eyes on the next Nvidia, the next Tesla, the next Amazon, but there's a lot of opportunity lower too.
Yeah, like if someone can bag, 5 or 6 or 7 10xers over their investing career over 20 years, they're doing fine. They're doing great.
Yep,
They're gonna have a
exactly,
nice big
exactly,
portfolio.
exactly, exactly. And the other interesting part about 10x stocks, I mean, it happens to all kinds of stocks really, is the round tripper effect.
Hmm.
Um, I think most investors know that term, but that's basically exactly as it sounds. The stock goes up quickly and then it comes down and it does a round trip. So basically, it ends up where it started. And this can happen with 10x stocks too. And in fact, sometimes you can actually end up, I mean, depending on where you buy and sell, you can actually go past a round tripper and actually lose money. So you can go from 10x all the way to a negative return. So actually, in fact, of 10x stocks, 10% in the last 10 years actually have a negative 10-year total return. So a lot of easy come, easy go, if you will. So just something to be very aware of. 2021 produced a fair amount of 10 baggers, and we'll call it temporary 10 baggers. But yeah, they just weren't able to hold it.
So for the round trippers, are there commonalities in which people can look out for and avoid those stocks that'll they'll do a full round trip and even more possibly?
I think I haven't researched it exhaustively, Robin, but I would
Hmm.
say the faster they do 10x, the fa- the faster
Hmm.
they come down. So it's kind of a general rule of thumb. I
Hmm.
mean, the best case is nice, slow and steady. I mean, the smaller the stock, the higher or the faster it will go. But still, you kind of have to look at it overall. I mean, if it's doing 10x in 6 months, then just be careful.
Hmm.
Okay, so what are the factors? Um, so I've looked at various factors over time, over my own investing career with microcaps. I look at all kinds of different factors: value, growth, timing, momentum, the size, sentiment. But I've just kind of targeted certain factors and just curious how they worked out for 10x stocks. I kind of found a few that were quite interesting. So I've listed them here, and I'd be happy to go through them.
Please.
So when it comes to returns, there's I think many investors just look at the returns and say, oh, hey, it returned 100% or returned 200%, which is fantastic. But sometimes it's interesting to understand what's really driving those returns. Um, I mean, you hear many people talk about multiple expansion, earnings growth, but to actually quantify those, there is a way. I mean, it's a simple algebraic expression, really, where the return of a stock is basically the sum of the return of the multiple expansion, the profit margin growth, and then sales growth, where these two are actually earnings growth together, sales and profits. So you can actually break these down and then calculate what really is driving those stocks, like what's really driving those returns. If you take an example here, XPEL, this is a really popular stock. It was a microcap. Now it's much bigger. It's actually been a 20 bagger in the last 10 years. And over that time, all like more than 75% of its entire return has been driven by sales growth. So it's just been able to grow, scale, and that's been the major driver. Constellation software, which is always a popular one, same thing. So as you can see here, the multiple expansions, I mean, these are, still significant, but a lot of these are usually the minority. So over time, 10x stocks really, as we'll see in this slide here, it comes down to sales growth. I mean, these companies really have figured out how to scale. I mean, that's what sales growth comes down to, really, is how it scales. I mean, sales, not to be cliche, but sales really is the life force of a company. I mean, without sales, you have nothing, really. I mean, you need sales to get your earnings, to get your margins, to create value. And just of those 10x stocks in the last 10 years, nearly half of them, really, the major driver was sales growth.
This is a key lesson, Ryan, because you can screen for small cap stocks, microcaps under 300 million, only on the basis of profitability. Sure, you can find some very profitable microcaps, but are they growing? Are they doubling their revenue every year? And this is key, as we can see in the pie chart. For people who don't know what multiple expansion is, can you just explain multiple expansion?
Sure, yeah. Of course, no, great question. So think of your PE multiple, your price to earnings. So if your price to earnings ratio is say 5, over time, a multiple expansion is simply going from a PE of 5 to a PE of 10. So for a given earnings, when it's PE of 5, the market's paying $5 for $1 of earnings. But then if it manages to get up to a PE of 10, that means the market's valuing the stock's earnings more. There's more value, so it's giving you $10 for that same dollar of earnings.
Yep.
It's basically the driver behind value. So value investing, you go in, you try and find, say, low PE stocks or low price to book, low price to free cash flow, in the hopes that it will basically multiple expand and then go to that next level.
And number one on your list, NVIDIA being the perfect example that it's that hyper revenue growth that we've seen in NVIDIA for years, right? I think my eyes aren't too strong. Is it above 40%? I think.
Yeah, that's 40%
okay.
Sales growth.
Yeah,
it was almost half of its return came from sales growth.
Yeah. Are there any other notable examples we can go through on the list here? I know you talked about Expel, Constellation, NVIDIA.
SMCI is a popular one. Let's see here. Baseline, Broadcom, Axon, Expel, Mercado Libre. That's another
the Amazon of Latin America, right?
Another popular one. So yeah, I mean it's really, yeah, I mean when you break it out like this, I mean it kind of cuts through the noise, because a lot of well, not a lot, but there's a lot of different thoughts on what really drives returns. It's sentiment, it's story, it's expectations, it's excitement, it's just the market, it's just kind of a lot of gray things you can't really touch, but when you're able to quantify them, it really kind of clears things up, and then you realize just how, I don't want to oversimplify, but just what the real drivers are of stock returns.
Yeah. So if someone wants to run a screen, maybe after they watch the video, listen to the conversation, they can maybe start at revenue growth, right?
It's definitely a good start. Yep.
Yeah.
Definitely a good start. Okay. All right. ROIC, return on invested capital. This is a very popular metric in investing. I mean, it's taught in business school and textbooks, in blogs, it's in investing article. I mean, it's everywhere, and it's a very key metric for many investors. I mean,
absolutely. This is why I called the show the Capital Compounder Show. It's a key one.
There you go. You take your ROIC, you compare it to the cost of capital, and then you're able to see if value is created or not. So that being said, ROIC is quite frankly, it's kind of a noisy metric for different reasons. I mean, if you just take high ROC stocks and just test them, you take a basket of the highest ROC stocks, that basket of stocks will actually underperform the benchmark. Now there's very nuanced. There's lots of different factors, but and then the fact that intangibles have become more prominent in financials now. Intangibles aren't really incorporated into a traditional ROIC calculation, so it kind of skews the numbers a little bit. But what I found particularly for ROIC is that just the absolute value isn't really that important. It's more the trend of the ROIC.
Improving ROIC, it looks like here, right?
Improving.
More than 60%. Okay.
So really, this is just a screen here. So of all those 10x stocks, 60%, as you just said, Robin. Yeah, really. I mean, after the low, I mean, some of them even had negative ROIC. Generally, the trend is that they're improving in their ROIC. I mean, even Tesla. I mean, Tesla is if you want noisy, this is pretty noisy here. I mean, at its low, had an ROIC of negative 67%. And then even today, it's only at 3%. But here we are. I mean, it's 10x.
Yeah.
And even still, compared to negative 67 to 3,
there's still room for improvement, right? From 3 until
definitely.
who knows where Musk will take it, right? To 30 to who knows 20. So my favorite source for return on invested capital when I want to look out, for the past 10 years is Morningstar. I don't know where you go, Ryan, for this figure, but it's a nice table. It shows our return on equity, return on invested capital. It shows all the other margins.
Okay.
A nice snapshot. How about you?
I actually have my own formula that I use in the platform that I usually get into is Portfolio 123.
Okay.
So I have a custom formula which is based on, I guess, the traditional value, and then it also looks at incorporating some of the intangibles.
Mm-hmm.
So it applies factors to try and make that invested capital value a little bit more, I guess, modern or up to date.
Mm-hmm.
Which again is still tricky because you're still making assumptions as to what the actual invested capital is.
Yeah.
But yeah, no, it's definitely a very interesting metric for sure.
That's interesting. So if we look at other notable examples here, there's Tesla, Nvidia again is showing up. Are there any others you want to highlight in the table?
Yeah, I mean, let's see here. If we've got Coca-Cola here, I mean, at its low, it was at 2%.
Yeah.
And then it actually dropped a little bit, and then it got up to 11, got up to 16, and now it's at 30.
Yeah.
So I guess the other point here too, Robin, and everyone, is that if you look at a stock that already has a high ROIC, it's probably too late for a 10x, because that a high ROC generally is a stock that's past its growth phase. Whereas as we see a lot of these stocks out there low, I mean, these are pretty, well, a lot of them are negative. Others are high. Nvidia's high. A few negatives here. Coca-Cola's 2. Cover Systems 10, 16. And then up to today, we're really into the high double digits, even triple digits.
Yeah, we are. And most of these companies are large or mega caps, like in the case of Nvidia.
Yeah, exactly. It's a mega cap for sure.
Mm-hmm.
Okay, that's ROIC. All right, and then free cash flow. I mean, this is also a very popular metric, and very similar trend to ROIC. I mean, if you look at the 10x stocks today, 80% of them have a free cash flow margin greater than the U.S. median.
Mm-hmm.
And again, 84%.
And the U.S. median being 7.7%.
Yes.
Look here. Okay.
7%. And then a lot of these stocks were improving their margin over time. but interesting here at the low, when all these stocks were just starting their ascent, 44% of them had a free cash flow margin less than the median.
So it's a similar finding then, Ryan, to the previous metric, which is return on invested capital. You need a trend upwards. They're not all
Correct.
starting at a high point, and that's how you catch the big baggers, right? The 10, the 20, the 30 times.
Correct.
Right.
Correct.
Okay.
Okay. So dilution. This one's a bit controversial. Because dilution. So okay, I guess first
It's so common, isn't it? That's probably why it's controversial in microcap companies. Yeah.
That's right. And I guess sometimes, or I guess first, what is dilution exactly? So dilution is basically going out to the market and then tapping the markets for more equity to get into your financial. So it's basically capital that in theory you use to then grow your business. It's like debt too. It's just a different form of capital. But as you said, Robin, especially with a lot of maybe poorly managed microcaps and stocks, dilution can be a sign that if it's a very unprofitable business, it keeps tapping the market for more equity. More equity keeps diluting. It doesn't deliver, and then it just keeps going downhill. But so there's kind of a stigma along the dilution, but really it's still capital. So if a stock or a business is able to take that capital and then use it to grow the business, then all the power to them. Again, it's just like debt as well.
Yeah. It's all about allocation and then the return on that
Yes,
allocation, right? That matters. Yeah.
exactly. So I mean, it's still a cost. But I mean, if you're creating value, then it's definitely a good thing. So anyway, the key finding here is that over 60% of stocks being 10x actually did dilute, but they managed to create value. So it's I
So it's
think
not always
just
bad, right? Like if you look at a
right.
balance sheet, you look year over year or the past 3 years, there's a higher share count. But then if they're delivering value, as you showed here,
Exactly.
62% of stocks that have 10x in the last 10 years have diluted their shares.
Exactly. Exactly. Yeah. It's all about how businesses manage it. Definitely.
Mm-hmm.
Okay. Oh, this is a bit off here, but yeah, this is another.
Here's an important one. Yes. Tell us about it, Ryan. Insider ownership.
Sure. So this is again another kind of like dilution. This is a popular metric in books, and then on Twitter you see stats of people tracking where insiders are buying stocks. But really, when you look at the data, I mean, not just with 10x stocks, with stocks in general, there isn't really a strong signal when it comes to buying or selling stocks. It's not really a strong factor. I've got a few theories on why that is. Um, um, and maybe that's a topic for another.
Let's hear them. Yeah, Ryan,
Well,
let's
sure,
talk about the theories. If they're not substantiated yet, but let's hear what they could be.
sure. I mean, it's well, I guess we could go down a rabbit hole here, but I guess the first part is that even though an insider has a perspective on his or her business, and they're very focused on that business, but investors, like the market, is looking at not just this stock; they're looking at all stocks, the entire market. So, I mean, even though an insider may be buying a stock or buying more stocks of their company, that's not to mean that there aren't better stocks outside that are, I guess, superior to that company. Um, the market is always looking at all opportunities at all times. It's basically how I see it.
Mm-hmm.
So they're always comparing stocks against other stocks. So zeroing in on this as a signal, I think kind of makes sense. The other reason is that really, as humans, as investors, I mean, we have all sorts of we call them cognitive biases. I mean, if anyone's familiar with Kahneman, thinking fast and thinking fast and slow, prospect theory, there's all kinds of ways that our brain kind of is wired, and it isn't really isn't really designed well for investing. So as investors, we're always up against ourselves sometimes as our top opponent. And so that's as investors, but also as business owners. I mean, business owners have these same cognitive biases. I mean, they're not superhuman by, at least I don't I don't think they are, but they're still subject to those same biases that all investors go through. So so I think those two combined might be part of the puzzle. I mean, I'm still working on my theory to to put it into writing, but that's basically my my approach to it. And I
That's
guess the
interesting,
third
Ryan.
reason is
And
to
and the findings are quite clear, right? Like here you show for stocks returning 10x in the last 10 years, median insider ownership was only 4.3%.
4.3. That's it.
Yeah.
That's it. I guess the other part is that, and maybe this is the most important one. I mean, high insider ownership doesn't mean that it's shareholder friendly insider ownership. I mean, those there can be very different incentives for insiders, and shareholders may not be their first priority. They may have other KPIs or other, so I don't want to say agendas, but just they have other objectives, and it's just something to be very careful of.
Yeah, and
So
if you want to highlight some of the examples here, right, just to show, how
sure,
low some of the insider ownership is, but the stock performance has been
yeah,
exceptional.
I mean, AMD right off the top here at the low was less than
Yeah.
1%,
Yeah.
but I mean it's 3,700% here in return. Amazon is higher now. I mean, it's 18%. It's done 10x. Greece is higher, but I mean, when you run through a lot of these guys here,
Yeah, well,
Copart,
Broadcom, right? Like super low
Broadcom,
insider ownership.
very low. Axon, Camtech, Builders, First Source. I mean, these are all 10x and higher, but really very low in insiders here.
So for an investor looking for, let's say, like 20, 25%, 30% skin in the game, it might not matter that much. And
Right.
the results show that you shouldn't pass on an opportunity because insider ownership is under 5%, because
Correct.
it's actually the
Correct.
opposite
And
effect. Yeah.
I think again, I don't really use insider ownership as a factor, so I'm not
Yeah.
um, I'm not an expert in using it, but I would say that if that is a factor that's interesting to some investors, it's just understanding sort of who those insiders are, what their incentives are, what their objectives are. I think will definitely help too.
Quality of insider ownership. I love how you coined that, right? There's a nuance.
Definitely, definitely. And then even if we look again at trends, the trends of insider ownership is actually it actually decreases um, over time. So I
As
mean,
a company gets bigger, there's more institutions buying in, I would imagine, right? And there's more shares being
right,
issued, as you showed earlier, and
insiders
there's
step
natural
back.
dilution. Yeah.
Yep. So 75% of them, in fact, ownership decreased.
And that's what you want to see, I guess, right? Like in the successful microcaps, to get big, like when Walmart went from basically a micro or small cap, however you want to argue it, to a large or now mega cap today. It was the inflection point whereby institutions started noticing Walmart years, decades ago, and started investing. And this is the natural progression. This is what you want to see.
Sure,
Yeah.
for sure, for sure. It's interesting, definitely. This is a funny one, or funny in interesting one. So EPS estimates. So analysts, I mean, they always get a lot of heat, uh, but EPS estimate dispersion is basically how scattered those estimates are. So on a given stock, you may have 2, 5, 10, 15 analysts uh, providing estimates for their earnings. So what they think next quarter is going to be, what they think next fiscal year is going to be. So historically, the estimate to dispersion, or the difference between the high and the low, is about 10% for the S&P 500. But at the low, for 10x stocks, 30% of them had much higher dispersion, 2 times or higher. And then, in fact, some of them even had negative estimates. So the point.
So
here,
these small companies start out as very mixed bags, basically, right? Like there's no certainty at all by even professional analysts that these are going to go on to be 20x companies.
Exactly, like that. Even the analysts don't know. Like they've, as you said, they've got different opinions. I mean, someone says, yeah, it got high earnings here. The other says, no, it's gonna be low. So they're very different, very difficult to catch that way. So using analyst estimates typically isn't the best way to find them at their low.
And I think we're probably going to upset some of the analysts watching the video, but that's okay. We might have to do some more homework.
Yeah, no harm intended. So this is always an interesting one. Market cap, as we've been talking about, microcaps. That's near and dear to my heart. So interesting one here, and maybe not so surprising, but 52 of the 52 stocks returned 10x. More than half of them started off as small or microcaps. I mean, I mean, there's more stocks in that universe. They've got more runway. That high growth period is usually when they're younger, when they're starting out. So I mean, it's maybe not too surprising, but again, it just validates that kind of thesis that a lot of microcaps do have that growth runway ahead of them. I mean, like anything, microcaps. I mean, you have to be very careful. I mean, they're also it goes the other way. I mean, a lot of microcaps are I mean, won't make it. They really won't. So it's just something that you need to combine size with all the other factors that we've talked about to help really weed out those potential risky ones.
Absolutely, but the silver lining here, and for people who don't want to, take on that much risk in microcap land, is that there are companies that will IPO at higher valuations, at a higher market cap, but still can go on to 10x. Is basically the point of the pie chart here that you show.
Definitely.
So.
Oh yeah. Oh sure. Yeah. Like I mean, the other half. I mean, large caps and mid caps can still 10x. Definitely. Okay. Growth by acquisition. I mean, I think, or at least maybe a few years ago, growth by acquisition was pretty. It was almost the consensus was that it wasn't a viable strategy. I mean, for real growth, it has to be organic. You can't grow by acquisition. They're poorly done. They destroy value. I mean, if you read a lot of articles and things like this from maybe pre-2010 or so, that's generally the consensus. But I think over time, the last 10 years in particular, seems to be a shift. I mean, a lot of companies are starting to figure it out, how to make acquisitions efficiently, how to truly create value, how to find those synergies, and it seems to be more viable. And then I think there's even a class of stocks like chronic acquirers that's their business model is that they just acquire businesses and then they just keep growing by acquisition, and they're very successful at it. So
Constellation Software being probably the diamond standard in Canada. Yeah.
Exactly. Yeah. Prime example there, Robin.
Yeah.
And that's kind of an interesting part. Is that when you look at 10x stocks, excuse me, the 10-year total cash flow spent on acquisitions, like scaled by invested capital, is basically almost 4 times higher than the broad Russell 3000. So I mean that it is an important aspect of these 10x stocks. I mean, they may not be serial or chronic acquirers, but definitely it's. I mean, if there's an opportunity, then it's something that they seem to be doing.
And this is a great table for people watching the video on YouTube where you show examples of companies that are growing by acquisition, right?
For sure, for sure.
Yeah.
Okay, okay.
Oh,
So
this is one of my favorite posts you made on X, right? This is great. This one blew up. So for
yeah,
people who aren't watching this on YouTube, 180,000 views on this one post. Ryan, tell me about it. Did this take you
I
by surprise?
yeah, it really did. I mean, it was just one of those things. I can't remember what I was doing. I just you know how it goes, right? Something comes in your head, you put it on Twitter, you think, okay. And then before you know it, it's yeah, 182,000 views. But I think the message here, and it's something I've kind of want to make clear, is that exactly as it says. I mean, 100 baggers, they're so sexy. I mean, if you say, oh yeah, I have a stock, it went up 100 times. I mean, that's like a showstopper. I mean, you walk into a room and that's it. But
It's so true. It's that unicorn out there, and for a
yeah,
lot of people, they were probably holding on to a stock that would have gone on to be 100x. But who holds these stocks like for that long? Because as you said, there's drawdowns, right? Like in a period of 20 years that it goes on to finally reach 100x. These stocks we draw down 50, 60, 70, 80%. In the case of Amazon, which is on one of your charts, right? Easily, exactly. Yeah.
it can be very tricky. I mean, I think Chris Mayer in his book, if I remember, he talks about the coffee can portfolio, where you just kind of set it and truly forget it. Like you don't even look at it, but still, like to know in advance what those stocks are. I mean, it's still extremely rare, extremely difficult. 10x's we've talked about, very cool. I mean, there are definitely some signals, but I mean, there are some very also precarious items too. Like, I mean, at the low, you just don't know. I mean, they give off some funny counterintuitive signals, so they can be difficult and they take time.
Yeah.
But then when you get down lower, the 2x, the 3x, 5x, even 1.5x, I mean, these are they're much more practical, I would say. Usually over shorter periods, especially in microcaps. Um, Even at just a portfolio of however many stocks you have, even if you bag a few of these over time, I mean, that will definitely accumulate
Hmm.
and help your portfolio. And you don't have to live through some of those gut wrenching drawdowns, which you don't even know if they're going to bounce back or not. That's the other part with a lot of these stocks, is that it's in hindsight.
Yeah.
You look at the S&P curve that we looked at. I mean,
Hmm.
during the 2008 crisis, I mean, we didn't know that we were going to get out of it, right? I mean, at the time, it's it. This is the end.
Hmm.
Yeah, but
Yeah, I
yeah,
remember those days. My goodness.
yeah, yeah. COVID as well, right? I mean, we thought,
Yeah.
okay, it's it. End
Yeah,
of
that's it.
humanity.
Sell the whole
But
portfolio, just walk away. It's over. The world's gonna end. I
yeah,
might not be alive.
exactly. But no, they bounce back, but sometimes they don't. So,
This is
but yeah,
beautiful. It's really a beautiful thing. Like it's attainable, the two times, the three times, the five times. And I think that's why so many people loved the post and reposted and liked it and everything.
yeah, I was
Yeah.
totally surprised, like just baffled. But hey,
Yeah.
I'm glad.
So something that we didn't go over, and I'm not too familiar with this. You have something that you call guts. Like it takes guts to invest in microcaps, but what does that stand for? That acronym, Ryan?
Sure. Yeah, no, guts is let me take a step back. So I guess a few years into my investing, started getting the hang of it, and so some people would ask, like, okay, so what's your investing strategy? And I say, oh, I'm a quantitative investor, and they say, well, what's that? And so you try and explain it, you as I explained at the beginning, but really guts. I mean, it summarizes two, I guess, a two-tiered approach for me, and for a lot of investors, they may call it different, but guts to me, key microcap stocks are high growth, G. You want to try and get them when they're undervalued, which is the U.
Mm-hmm.
And again, contrary to a lot of conventional thinking, timing really is important with stocks. I mean, you can't, especially with microcaps. A lot of microcaps are very cyclical,
Mm-hmm.
and buying and holding doesn't always work out. It works out quite often, but sometimes it's not appropriate for certain stocks. But timing your buys, timing your sells can be quite important. Can make quite the difference. So that's a big part of my approach, and also sentiment. I mean, how does the market view these stocks? Is there improving sentiment, or is there a lot of hate? Is there a lot of love? Is it improving? Is it declining? So, I mean, it's one thing to be contrarian, but you have to be a very strategic contrarian. I mean, to be contrarian for contrarian's sake it's not really a strategy to me, at least. But
Mm-hmm.
so that's kind of the stock factors, and then the other side is kind of your mindset or your behavior is guts. So G stands for gumption. Gumption can mean courage. It can mean just taking action. I mean, you can read all the books you want. You can do all the back tests you want. You can follow all these people on Twitter. But I mean, until you actually do it, or actually put something at risk, put something in the market and do it, I mean, yeah, I mean, you really have to just do it. I mean, it's simple as that. And then the U is uncertainty. I mean, uncertainty is a natural part of investing. I mean, we never have all the information. It's a game of odds, really. The future is unknowable. So at some point, you just have to get comfortable with that. I mean, you're never going to have all the information, but at some point, you need to make a decision and say, okay, I have enough, and then just make it happen. T is trust.
Mm-hmm.
Trust is another important one. And again, that can mean different things. Trust your decisions. So, I mean, if you've decided that certain stock or certain strategy is good for you, there's going to be a lot of people out there who are going to tell you otherwise. Or there's going to be a lot of people with strategies you think looks better than yours. The grass is greener on the other side. But at some point, again, you just need to trust your own decisions. I mean, if you spend a lot of time on something, and you've developed some sort of conviction, I mean, you have to trust that. I guess also more specifically in quant investing and evidence-based, sometimes you'll find something that's very counterintuitive, and it doesn't really follow the academics, doesn't really follow popular convention.
But
But I
the
mean,
analyst recommendations for that
yeah,
matter, right?
exactly. But I mean, if the data is telling you something else,
Mm-hmm.
I mean, and you've tested it robustly, then trust it, and potentially there's an opportunity there.
Trust is such an important factor because as we invested through the microcap world in 2001, 2, and 3, it was a very hard time to be invested in microcaps, and I think most people will probably just leave and never come back. But that's something that you have to push through and persist through.
For sure,
Yeah.
Robin. Yeah, I've probably you've heard these stories too. People say, "Oh yeah, I was on the market once. I made so much money. Oh, I made so much money." And then they'll say the next thing, "Yeah, I also lost all that money too." So it's like and then they're done. They go into real
Yep.
estate, or they
Yep.
do something else that has nothing to do with the market.
I've seen it happening time and time again. It's so true. Like there's someone super excited about the market and then they're out and they've allocated their money elsewhere, as you said, in real estate. You also I think you've created something called the Microcap Roadmap. as
Yes.
well, Ryan. Can you showcase that microcap roadmap? I think that's really important for
Sure.
people
Sure. Sure.
to
Sure.
understand the world of microcaps.
Yeah. Let me just pop that up here. Give me a sec here. Okay.
Okay, here it is.
Okay. So the microcaps roadmap. So what is that? So again, sometimes when you invest in microcaps and small caps, if you're in this universe, you see it a certain way, but then people who are outside may see it a different way. So, in my experience, maybe other small microcap investors' experience, I mean, small caps, microcaps, they kind of have different outside views. I mean, many outsiders, many investors believe they're all frauds, or they're all scams, or they're all pump and dumps. I mean, they're not really serious stocks. I mean, they're not real businesses.
Penny stocks has that negative connotation,
Right.
right? Like I've been
Exactly.
hearing that forever. Yeah, like you're
I mean,
investing in
anyone,
penny stocks.
yeah. And then anyone who's watched Wolf of Wall Street, I mean, that really drives home that whole idea too of the whole pump and dump.
Yeah, that was a great movie.
Oh yeah, fantastic. Oh, great movie. Um, and then you got the other side of microcaps where is completely the opposite. It's like pie in the sky. I say, oh, microcaps. These are going to be the next Amazon or the next Tesla or the next Nvidia. Like, there's so much opportunity there. You have to invest in microcaps because the sky's the limit,
Hmm.
which is kind of not true either. I mean, it applies to some,
Yeah.
but really I guess what the truth is, there's kind of a spectrum of microcaps. And the fact that why this is quite important is because over half of all U.S. listed stocks are microcaps.
Hmm.
More than half. I mean that's a lot of stocks. So much potential opportunity there. I mean, you could slice this different ways. I mean, microcaps, you can even split that even further. So microcap is typically 50 million to 300 million in market cap. So that's 30%. You've got nano caps, which is about 10 to 50. That's another 25%. Then the bottom is what we call pico caps, which is just absolutely tiny, from 0 to about 10 million.
I'll be
And
honest, it's my first time hearing pico caps.
yeah,
That's so cool.
yeah, it's kind of a funny term, but yeah,
Yeah,
it's but look, I mean,
yeah,
half of all micro caps are pico caps. So yeah, I mean, it's very small stocks. I mean, a lot of these have no revenue, and a lot of them probably are not legitimate businesses. But I mean, that's why the investor needs to go through, do his homework or homework.
absolutely. And
Um,
so, out of the half of the 10,000
yeah,
U.S. listed
half.
stocks, are microcaps, and then only about was it 60% have revenue
Yep,
over growth, right? Is that what we're
correct.
looking at here? Can you break
Yeah,
that
it's
down?
just purely sales. Like if they have
Okay,
sales, then that's about 60%. If there's no
got,
sales,
got it.
it's 42. I mean, so this will be like your biotechs.
So
It,
even like
um,
pre-revenue, pre-commercialization, that they haven't commercialized a
exactly.
product or started selling it yet. Okay, so it's okay. Yeah.
Yep. Yeah. Yep. Exactly. And then you can break down those revenue stocks that do have revenues into sort of two subgroups. I mean, you've got those that are actually growing sales. So as we said
Yeah.
with the 10x stocks, sales growth is an important metric. So over 3 years, just to uh, 1 year isn't usually enough just to get that
That's the
idea.
hurdle. So you want to see over 0% growth. You don't want to see a decline, a shrinking
Right,
top line. Yeah.
right. And then so you've got your growing. I call them growing and slowing.
Mm-hmm.
And then of the growing, you've got those that are unprofitable. So earnings per share less than zero or net income's less than zero. And then you've got those that are profitable. And then in this camp, only about one third, roughly, are of the profitable sort. Then you can even break that down again into who's actually growing those earnings, and then who's shrinking those earnings. Um, And then on the other side, if you've got a declining stock in sales growth, you'll then also have the unprofitable bucket and then the profitable bucket. So there's, yeah, I mean, first, I guess the first takeaway, it just shows how many different sort of subgroups, or yeah, as I was saying at the beginning, kind of how microcaps are kind of a spectrum. Like there's different kinds, different shades, and they'll shift too. Like a stock will go from slowing growth to growing, profitable to unprofitable,
Mm-hmm.
shrinking earnings to growing. So
It's
it's
not
kind
always
of very
linear, right? In
very
the life of a microcap. Yeah.
exactly.
Yeah.
And then we can even take this a step further, and then many microcaps are cyclicals. So I
Yes.
mean, you'll have sales growth very strong for maybe 2 or 3 years, and then it falls off the cliff because they can't scale, or there's a particular market or economy that they thrive in. So that's even another level. But I mean, just at a high level, I mean, this it's just interesting how you've got these different groups, and hopefully for maybe investors who aren't as intimately familiar with microcaps, like uh, those who focus on them, it just shows, yeah, there's different flavors, different flavors.
Absolutely. And it just goes to show at the very bottom right here, you only have 337 companies left that, that are growing revenue,
Right?
that are growing earnings out of the, 5,600 microcaps you started
Yeah,
out with at the top of the filter. So it's a very small group of these exceptional companies that are also investable. So we have
exactly.
a good idea, Ryan, I think, of your selection process and what companies you're looking for from the 10 factors for 10x stocks. How about your portfolio itself? Do you manage a diversified portfolio? Do you prefer concentrated? How many stocks do you have at any given time in the portfolio?
Um, I run about at any time 4 to 6 different strategies, and then each strategy has anywhere from about 15 to 20 to 25 stocks each. So I could have about 100 to 120 stocks total at any time. So I guess at first impulse that may sound pretty diversified, but it is in one sense. But on the other hand, those are all microcaps, or small caps, and then they also have similar. I'm also looking for similar factors. Like I said, the guts, growth, undervalued, timing, and sentiment. So and actually in other ways too, I those portfolios can get quite focused at times in terms of sector
Mm,
concentration. I don't really limit how many stocks in the portfolio are in a given sector. So okay, I'll just so if energy is hot, if energy
hmm
is really performing, then I might have more in energy. But I usually won't trim them back. I'll just let them do their thing. Um, and that hasn't. I mean, maybe it does cause some volatility, but over the long term, it seems to be okay.
And what are each of those unique strategies? I know viewers will be totally curious to know.
Sorry.
You mentioned that you run several, and there's like four or five
Oh,
strategies, right? Like
sure,
buckets of portfolios. I think viewers will be interested to know what those are.
sure. So I usually talk with them again on Twitter, but I talk about guts. But four of those are guts strategies. So these are high growth microcaps that have lower valuations. That they probably have positive momentum in the timing sense. And I've got two US based, two Canadian based,
Mm.
and then I also have another strategy I call chill liquid, which
Oh,
are
tell us.
which are very, well, not very, but they're TSX venture stocks. So it's very similar to guts, but it's very focused on just stocks within the TSX venture exchange. So again, high growth. I'm looking for viable businesses. So pre-revenue, I typically don't deal with those. Not yet. I do have another strategy I'm working on, which may incorporate some of that. But anyway, high growth valuation. There isn't much sentiment in that group just because there is no analyst coverage. There's no short interest metrics. Not a lot of press. So it's a little bit even more quantitative that way. So that's a fun one. It's you get some really so in that strategy. I just bought a stock that had a market cap of 1.2 million Canadian.
Oh, so it was almost a Picocap. Like it just
was
missed
like
the mark.
it was a tiny Picocap, like 1.2 million.
Yeah.
Yeah, absolutely tiny. It took me I think a week and a half
Wow.
to fill that order.
Oh my
Yeah,
goodness, so
and
illiquid.
it's a tiny position too. It's relatively small too, but
Yeah.
still took.
My goodness.
Yeah, yeah. So that was fun.
Yeah. Have you are there any findings from the U.S. world versus the Canadian world of microcaps? Do you find that one country outperforms the other? Have you seen that yet?
Yep. Yeah, it really depends. It really depends.
Okay.
In 2023, so of call it those guts strategies,
Mm-hmm.
the US versions trounced the Canadian, like doubled. No question. But then in 2024 is exactly the reverse.
Hmm.
The Canadian just crushed the US. Um, so yeah, it really depends. I mean, as you know, and maybe the audience too, so Canadian stocks is a lot more resources,
Yeah.
commodities, miners. I mean, there is some tech, definitely, but US is a lot more tech. Canadian and American both have industrials, which are common in microcaps. But yeah, it can really depend. So I mean that's a good point, Robin. I mean that for me, and this is very different. I mean, one of the reasons why I like running different strategies is because if one's performing and one isn't,
Yeah.
they kind of balance each other out. So
Mm-hmm.
psychologically, it's okay. Whereas if I had maybe one strategy or even two and they're both underperforming, that would be quite difficult just to I guess psychologically manage.
Yep.
So yeah.
Out of those, out of those 100 or so microcaps, Ryan, can you share maybe the top 3 to 5 that you're most excited about for 2025?
Um, hmm. It's hard because
Yeah.
again, I'm not trying to avoid the question, but as a quant, you I don't get too attached to these stocks. Like they pass the criteria. I buy them and then I hold them as long as they maintain that score or that
Mm-hmm.
rank. And I don't really get too attached to them either. Even if they've done well, I try and keep arm's length because you're gonna sell at one point. So I'd rather not let my judgment get in the way there. I just let the system do what it's doing. Um, but what can I say? I mean, I guess generally, I'm, I guess you could say I'm bullish on energy for this year. I mean, I think like energy's had a really tough go last few years. Um, Other than 2022, it actually did well for unfortunate reasons with the Ukraine. But
Mm-hmm.
yeah, we'll see what happens this year.
Running a quant-based model, have you looked back at what your turnover rate is on average every year?
Yep. So it's around it depends, but some strategies range from about 150% to about 250% per year. So I mean, it's certainly not well, it's not buy and hold, and it's certainly not day trading either on the other side. I mean, I can hold a stock for maybe as short as a month or as long as 3.5 years. I mean,
Yeah.
it really depends. As long as it keeps checking those boxes and the strategy that it keeps that score, then it stays in the portfolio. If it doesn't, it gets sold. I mean, it's cold and heartless that way.
Yeah.
But I mean, I think that's the point. Like you keep your emotions out of it. You let the strategy do its thing, and you try and take the human element out of it.
And you mentioned two books at the beginning of the talk, right? You mentioned one up on Wall Street. I love that book too, Peter Lynch. You mentioned 100 Baggers, Chris Mayer. Chris, you're always welcome to be on the show, by the way. Shout out. Have you read, Ryan? I'm curious now that I know you're a quant investor. Have you read What Works in Wall Street by
Oh yeah,
O'Shaughnessy? Yeah?
yeah, yeah. No, that's a great book. Yeah, I love Jim's book. It's fantastic, really well written. Read it cover to cover.
It's like a
It's,
Bible. It's huge,
oh
right? Like
yeah,
it's the biggest
it's tables,
book.
graphs. It's great. It's great. Um,
And what was his finding again? Basically, I think it was all about what you just talked about, right? If you want the best outperformance, it's to find these smaller companies.
yeah, yeah. I think he talked about small caps and microcaps. And I think also another one of his key findings too is that combining factors is important. So you hear a lot about the value factor. I'm only a value guy. Like I
Yeah,
only look at it could be price to book or price to earnings or what have you. But when you combine like the value with the growth, with the momentum, and with the quality, I mean, then things start to really happen. Um, I mean, you're I guess diversifying that way, but you're just improving the quality of your criteria. I mean, you're looking for a lot of good things, and so at least it should improve your chances of finding the stocks that do go on to outperform.
yeah.
Um,
You mentioned at the beginning as well, Ryan, a site or a software I've never heard of. Was it Portfolio 123? Like, this is where you run your numbers. Can you talk more about that?
sure, yeah,
Yeah.
portfolio 123. Yeah, that's a key part of my approach, really. So it's basically a quantitative software. It's a screener, backtester. It's got all kinds of features. It's great. It's got data, very clean data, high quality data back to 1999.
Oh, wow.
So you can really backtest pretty much anything you want, like anything that you can think of. I mean, there's lots of uh, call it out of the box factors like PE and price to book, and then you can create your own. You can create your own version of PE or your own growth factors, and then just test it over time, different sub periods. How did this strategy work during the financial crisis or just after? How did it work during COVID? I mean, you can test all this stuff out. Um, it's a wonderful platform. I mean, it really is very powerful, very good data, and they're constantly adding new features. I mean, they even have a new AI suite of AI features, which I haven't even touched yet. But no, it's a great platform and a great community. I think that's one of the high points too. I mean, it's a great platform, but the community, it's great. You can ask questions to each other, solve problems, think about ideas. Uh, Very cool.
That's interesting. And for viewers of the show, we're not getting paid for this. We're not affiliates by any way.
Sure.
Is it free, Ryan, like to use
Oh no no
Portfolio
no
123?
no
Okay.
no. It is paid.
Okay.
It is a paid platform. But I think for what you get, it's the cost is just a fraction of what you pay for some of the really um, really what I'm trying to say, like some of the really uh, like the really expensive. There are very expensive options out
Yeah.
there. But Portfolio with three is excellent value, very versatile, very customizable. Um, you don't really need to know programming or Python. I mean, some people use Python
Hmm.
to do sims and backtest. I mean, they do have their own kind of, I guess, coding that you do have to do to a certain extent, but I mean, it's not like your Python by any means.
Outside of Portfolio 123, where else do you gather information and discover new microcaps?
Um, it, I use portfolio 1 to 3 a lot. Like
Yeah,
that's a big
it's
part
got
of the
everything you
business.
need, right? That's what it sounds like.
Pretty much. I
Yeah.
mean, it's I mean, the odd time on Twitter, if someone's talking about a stock, I may check it out, see how it ranks in my strategies. Um, but I guess I'm a bit reluctant to get too excited about stocks on Twitter because if they're too popular, then maybe they've had their time, um, which is something you have to be careful of.
Mm-hmm.
But and I guess that's the whole point of the approach here being quantitative is you take that part out of it. Like it's purely quantitatively driven. It's an algorithm that's picking your stocks that at the beginning may not be obvious that they could be winners.
And then maybe in 3 years, people will be
Yeah,
talking about it on
yeah,
X
yeah,
all over, right? X has almost
yeah.
become the newspaper. Like as soon as the stock shows up in the newspaper, it's probably too late, right? Going back to your point.
Right, right. Or even that the joke is right when it's featured on the cover of a magazine. It's the complete if it's bullish,
Oh,
then it's
Business Week, right?
actually a
Yeah,
bearish signal.
it's the curse of that one particular magazine. Is so true.
Yeah.
Um, that's super interesting. How can people find you? Obviously, we talked about X. They can go on there and search your name, Ryan Telford. You crossed the milestone. I think you're at what 5,000 followers now on X. But they can also find you on Seeking Alpha. Is that right? You also write
Correct. Yeah,
reports.
yeah,
Yeah.
yeah. No, I like to write about quantitative ideas and things that just hopefully others can kind of apply to their own strategies. So I've been doing that for a few years, and I like to ramp up my writing on there for this year. So please just come on over, check it out, just under my own name. And then, as you mentioned, Robin, a recent new member of Microcap Club. So if you're a member there, come on over. Um, yeah,
Yep.
join.
People can come by and say hi to Ryan, right? This has been a lot of fun, Ryan. This has been a great conversation.
No,
It was
same.
great getting into the
Likewise.
science of microcaps, right? Those 10 factors. I'm sure people are going to go back and look over all the slides, right? If they weren't
Sure.
watching initially. But yeah, thanks, Ryan. Have a great one.
Thanks, Robin.